4 defining considerations of debt. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, lower middle market, M&A and capital advisory firm, helping companies generating $1 million to $10 million in pre-tax earnings, sell their businesses, and secure capital. And so oftentimes clients come to us and they say, we're seeking capital. And although we do like to contemplate it as a continuum between equity and debt, and not just purely a binary of just equity or just debt, for purposes of this video, we're going to dig into just debt. And so when people come to us and they say, the objective is truly to retain as much equity as possible, and therefore we would just like debt, because debt is not dilutive in that sense. And so a straight loan, if you will, is someone giving a company capital and that capital being repaid. Ownership, or any percentage of ownership, does not trade hands in that situation. There's a lot of complexities and granularities and all sorts of types of debt. Sometimes that can include equity components to it, but for a very simple way of looking at it, in a bank situation, for instance, is traditionally just a loan and a repayment. And so in those situations, someone says, what should I be looking for? What should I be considering for debt? And we really break it down into 4 specific components of a loan. So the first of these is duration. Duration is the length of the loan. Now, it is not amortization, which we'll talk about later, which is the length of the repayment period. There are some loans where amortization and duration can be the same, but in many situations it's different. So the duration is truly the time frame between when the lender or capital provider provides the loan and when the loan ends. And so again, we'll hit on that in amortization to get into a bit more detail, but duration is the first key variable. Number 2 is the cost of capital. And again, barring any equity considerations, cost of capital will traditionally just be an interest rate. And so you borrow money from a bank at 7% interest, you borrow money from a non-bank lender at 12% interest. It's all situational. It all depends on collateral, which is going to be our next variable we discuss. Cost of capital in a debt scenario tends to be an interest rate. Number 3, as alluded to, is collateral. What is the loan held against? And so you can almost think of it like borrowing money from your friend at the playground as a kid, and he said, well, let me hold your basketball until you pay me back the $2 you borrowed to buy Cracker Jacks, whatever the situation is. But that is the fundamental concept of collateral. And sometimes the bank can possess collateral, sometimes and oftentimes it does not. But the idea of collateral is what can be liquidated or monetized to return the capital to the lender in a situation where the borrower defaults or fails to pay back the situation. And so oftentimes in certain types of debt facilities, it can be collateralized by inventory and accounts receivable. In some situations, it can be collateralized by equipment and hard assets. Those are on the simpler side of things. But alternatively, it can equally be collateralized by, obviously, the ongoing cash flows of the business, but the brand of a company, the goodwill of a company, the rights of a company, if they have certain rights to do certain things or operate in certain areas. And so there's a lot of things that can be collateralized. And I'd say probably the utmost collateralization of a loan is a guarantee or a personal guarantee. And so although people will contemplate that somewhat differently than collateral, it's oftentimes conceptually, it's effectively the assets of the person, whether it's the sponsor, executive, borrower, whoever is the guarantor of the loan, that their personal assets would effectively be collateral for the bank in the case of a default. Where that can be avoided, we try to avoid it. However, it's not avoidable in all situations. But there are mechanisms or techniques to try to have a personal guarantee for a finite period of time, a personal guarantee until a loan balance reaches a certain level of amortization, which we'll get to again. But where you can avoid a personal guarantee, it's great to do so, and where you cannot avoid it, we try to create a sunset or a burn-off provision, if you will. And sometimes it's not doable. However, if the collateral for the loan would be sufficient to repay the loan, then the personal assets would never be touched. So there's a lot of things to contemplate. However, in the spectrum of collateral, you'd probably start with the very liquid assets of the company, cash, AR, inventory on one side of the spectrum, and on the other side of the spectrum, looking at the personal guarantees as recourse or collateral for the debt. Lastly, as we've mentioned a couple times, is amortization. So this differs from duration in the sense that amortization is the repayment schedule for the loan, where the duration of the loan is the actual time in which the bank will allow the money to be lent. And you'd say, well, if the bank lends the money for 5 years, at the end of 5 years, shouldn't it be repaid? Not necessarily, because sometimes, again, the amortization schedule could be, let's say for round numbers, 10 years. And so If it's a 10-year amortization schedule, you're paying down, let's not complicate it with a fully amortizing situation, but if you just said it's a straight line amortization of the principal, you'd be paying down 10% of the principal every year. And so if it's a 5-year duration, 10-year amortization, you would effectively be at a 50% principal loan balance at the end of 5 years. Now, what happens then? There's effectively a mandated bullet payment, probably a year or sometimes even more before you reach that end of the loan duration. You would be going back to that lender to try to negotiate either an extension or a refinancing of the debt. We're speaking to other lenders about the same thing. And again, the refinancing can be, let's say you're at the end of 5 years and you refinance it for another 5-year duration and another 10-year amortization, your actual loan payment will go down considerably because now you're spreading out the 50% of remaining principal over the next 10 years, while in the first situation, you're amortizing 10% of the debt per year based on the 100% principal balance. And so the end of the duration, even if it's not the end of the amortization, can be the point in time where you either refinance, you could just extend it on a similar kind of straight line for another 5 years for the balance, but oftentimes it's an opportunity to lower the payment depending on what the situation is. And so, to recap, the 4 defining considerations of debt are duration, the cost of capital, the collateral, and the amortization schedule. And so, as you're contemplating who may you want to borrow money from, whether it's a bank lender, a non-bank lender, what are some of the drivers to consider? Well, it's uses, it's projections, it's the implied risk of what you believe you're undertaking and how certain you are of the outcome. Because think about it, what is the gambit you're really undertaking? Is you're saying, I want to retain all of the equity in the business or maximize equity retention in the business because I'm so confident that this plan is going to work that I'd rather just borrow the money. Because if I'm borrowing the money at 7%, but the return on our invested capital in the business, you'll see ROIC is the acronym oftentimes, or the return on deployed or allocated capital is 20, 30, 50, 100%, well then you'd rather pay the interest on the debt and keep increasing the value of the equity of the business disproportionately and retain as much ownership as you can. Now the risk of that is obviously there's real cash payments that need to be made. There's true debt amortization, and so it will impair or eat into cash flow, and so you really need to be confident that the results are going to be the results. So these are just some general thoughts to contemplate relative to debt, some of the key characteristics of it, and certainly we're talking to clients and prospective clients every day about whether debt, equity, or some combination or some gray area in between of both is the optimal solution. But that's a thought for today. Hope the week's getting off to a good start for everyone. Keep pushing forward. God bless. See everyone next time.